we have these winners trading on very high multiples, but there are other parts of the market that have been left behind because they're deemed to be old world, old school, affected by the pandemic, and weighed down by the legacy of hard assets. And so the way we're trying to position our portfolios, if you like, is to firstly avoid those very expensive parts of the market where they're unprofitable companies that may be COVID winners or may not, but certainly there is any whiff of higher interest rates or a whiff that those high growth rates won't continue on for many, many years, those companies will be most affected. So we're avoiding those very highly priced parts of the market. We are also avoiding what's often referred to as quality defensive companies. So companies that have very solid and dependable dividend yields. They've done very well out of a long period of declining interest rates, but we think that story's run. And those companies are essentially bond proxies, so they're like owning a long-term bond, which is a terrible bet right now. So we're avoiding those companies as well. And within what's left, we're running a really barbell strategy. So we like growth, we just don't like to pay for growth, but we're finding some really interesting opportunities of companies around the world that are growing at very attractive rates. And because of short-term circumstances, whether it's the COVID-related issues or other company-specific issues, they're available at very attractive rates. And so we're trying to find these really high-quality, dominant companies that have demonstrated long-term growth, and at the current price, we think make very compelling investment opportunities. So we have those in the portfolio. We also have at the other end of the barbell companies that are a bit more cyclically exposed, a bit more pro-cyclical, a bit more economically sensitive, and perhaps have been hurt in the short term by some of these COVID dynamics. But we think offer very attractive long-term value because ultimately this will pass, as everything does. Ultimately the world will get back to some form of normal. And there are some companies that have demonstrated 15% per annum growth, very high returns on capital, increasingly dominant market share positions, who will come out of this dynamic much more strongly than they went into it because weaker competitors fall over, they're able to buy other competitors to strengthen their position. So we own companies like, we've bought companies like CBRE, the real estate services company, which is an incredible business and we think will come out of this period stronger than ever, and have grown at 15% per annum for the last 10 years at very high returns on capital. Very dominant global company that's very well positioned to help their clients manage through this crisis. And we own companies like Wuliangye Yibin in China, which is again a local champion. It's one of the leading Baiju companies in China. It's growing earnings at 25% per year, and we had the opportunity to buy that in February of this year when really at that point only the Chinese market was being affected by concerns around coronavirus, and the share price was declined materially. And so we bought again a very high quality company that makes north of 100% returns on invested capital, growing at 25% per annum, very, very strong pricing, demonstrated pricing power for a brand that is literally hundreds of years old, a consumer brand. So these opportunities are around the world, and we think by running this kind of barbell approach of these genuine growers like a Wuliangye Yibin and these more pro-cyclical, more economically sensitive businesses like a CBRE that will do very well coming out of the crisis as we come out of this recession, we think our portfolio can be very well positioned for whatever trajectory we take out of this